Hello, everyone. Today, we will be studying Lesson 5.6 of the Development of Digital Currencies, Case Studies in Digital Currencies Regulation. The global practice of digital currencies has given rise to diverse regulatory paradigms, with the core contradiction lying in balancing technological innovation and systemic risks. This lesson examines regulatory cases from typical jurisdictions to reveal the operational logic of legal adaptability reforms, penetrating risk supervision, and international collaboration mechanisms in specific scenarios, providing empirical support for building a resilient regulatory framework. Now, let's delve into specific cases of digital currencies regulation, analyzing them from 4 dimensions: legal attribution, technological penetration, international coordination, and dynamic balance. By the end of this lesson, you will have acquired 4 core competencies. 1. Deconstructing legal attribution mechanism, Switzerland's proprietization approach, or EU interventions. 2. Applying regulatory tools such as on-chain circuit breakers, enhancing risk management efficiency in DeFi. 3. Designing cross-border joint prevention mechanism with sovereign concessions, BIS data sharing, or G20 tax rate models. 4. Quantifying the balance between regulation and innovation, calibrating thresholds using the cost-benefit model of Singapore's MAS. First, let's explore innovative practices in legal attribution. The anonymity and decentralization of digital currencies pose significant challenges to traditional legal attribution. How have countries responded to these problems? 1. Institutional breakthrough in property law. Switzerland's principle of private key control constitutes ownership is groundbreaking. This principle addresses challenges in digital asset attribution through 3 aspects of innovation. 1. Resolving attribution dilemmas. Binding cold wallet biometric features is recognized as property publicity, granting on-chain assets protection equivalent to that under the Civil Code. 2. Restructuring judicial logic. Geneva courts have overturned traditional ownership recognition models, with actual control superseding formal registration, prompting 23 countries to revise digital asset inheritance laws. 3. Unleashing economic value. The clarity in attribution has led to a 470% growth in Switzerland's digital asset collateralized loan scale over 2 years, with a non-performing rate of only 0.3%. 2. Legal innovation in judicial intervention in smart contracts. Next, let's examine the EU's forced rollback of the Aave protocol, which signify a critical legal shift. 1. Establishing accountability for technical defects. Oracle failures are deemed major technical negligence, requiring developers to bear 82% of the loss compensation. 2. Creating legislative arbitration mechanism. The Claros random arbitrator system has become a mandatory preliminary procedure for on-chain dispute resolution. 3. Redefining contract ethics. The principle of code is law yields to law above code, embedding 25 mandatory compliance clauses into DeFi. This institutional insight teaches us the law must undergo a qualitative transformation from chasing technology to taming technology. The paradigm of control implying ownership was established by Switzerland's legislation, combined with the technical liability traceability framework of the EU's Digital Markets Act, collectively forms the new foundation for property law and contractual spirit in the digital age. Next, let's explore how regulatory technology has achieved qualitative leaps, shifting from passive response to active prevention. 1. The regulatory revolution of on-chain monitoring. The UK FCA's governance of Uniswap showcases three major innovations. Risk identification dimensions, analyzing MEV, miner, extractable value attack patterns to identify 15 types of arbitrage paths for price manipulation within plus or minus 35%. 2. Implanting regulatory tools. Circuit breaker smart contracts automatically freeze abnormal liquidity pools, consuming only 0.02% of on-chain computational resources. 3. Penetrating entity management. KYC certification covers 91% of liquidity providers, establishing an identity correlation map of 2 million addresses. 2. Risk hedging for algorithmic stability. Singapore MAS requirement of 300% over-collateralization embodies sophisticated design. One stress testing model. Collateral portfolios must withstand simulations of financial crises. On the scale of 2008 bond proportion is greater than or equal to 60%. Cash liquidity coverage ratio is greater than or equal to 130%. 2. On-chain verification mechanism. Chainlink oracles conduct daily audits of reserves, triggering a 48-hour business freeze if deviations exceed 2%. 3. Systemic risk blocking. A 110% liquidation line extends the transmission cycle of a Terra-like death spiral from 72 hours to 30 days. The technological leap here is regulators are shifting from ex-post accountability to embedded governance. The FCA's on-chain circuit breaker contracts and MAS Oracle verification system mark the compilation of regulatory logic into machine-readable code, enabling millisecond-level risk response. According to a BIS report, such technological regulation has reduced the DeFi market risk premium from 37% to 12%. The borderless nature of digital currencies demands that regulation transcends individual national boundaries to achieve international coordination. 1. Institutional design of data sharing networks. The BIS Project Galaxy addresses three major challenges. 1. Balancing privacy and regulation. Zero-knowledge proof channels allow central banks to verify transaction risk levels. Money laundering probability is greater than or equal to 87% without accessing specific account information. Sovereign concession mechanism. 47 countries signed the Data Sovereignty Tiering Agreement, permitting cross-border freezing of 12 types of mixer blacklisted addresses. 3. Quantum Defense Alliance. A shared library of Shaw algorithm attack signatures reduces early warning response time to 8.3 seconds. 2. Game equilibrium in capital flow taxation. The G20 linkage mechanism demonstrates intricate institutional design. 1. Dynamic tax rate function. Tax rate equals 0.5% plus foreign reserve ratio, 15% times 0.25%. For example, Argentina's 22% reserve ratio corresponds to a 2.1% tax rate. 2. Arbitrage cost control, real-time tracking of cross-market price differences via ISO 20022-228 standards, triggering temporary surcharges when arbitrage opportunities exceed the tax rate. 3. Tax recycling system. 60% of collected funds are injected into the financial stability funds of impacted countries, while 40% are used for cross-border payment infrastructure upgrades. 4. Global governance wisdom. Project Galaxy's ZK verification plus blacklist library and the G20's dynamic tax rate function create an asymmetric sovereign concession framework. While retain monetary policy independence, countries concede 0.3% to 1.2% of financial data sovereignty in exchange for systemic risk joint prevention capabilities. This quantitative sovereign exchange model has become a template for CBDC cross-border collaboration. Finally, let's explore how digital currencies regulation can establish a resilient framework amid multiple contradictions. 1. Technological radicalism versus financial conservatism. The privacy tiering of ECNY reveals its balanced approach. One technologically radical aspect. Tier 1 uses blind signatures to achieve 100% anonymity, ensuring monetary circulation freedom. 2. Conservatively preventive aspect. Tier 3's ZK snarks reserve traceability rights for judicial authorities, improving fraud recovery efficiency by 5 times. Its philosophical core is achieving marginal adaptation of freedom and security through transaction size tiers, thresholds of 200 yuan and 50,000 yuan. 2. National regulatory sovereignty versus cross-border risk transmission. India's anti-quantum migration demonstrates sovereign initiative. Mandatory adoption of Crystal's Kyber algorithms raises attack costs to $820 million, 256-fold increase compared to ECDSA, while ensuring compatibility with international standards via NFC quantum key distribution, QKD, avoiding technological isolation. This institutional insight teaches us sovereign technical standards must include interface openness. India's solution reserves compatibility modules for quantum channels with ISO 2002228. 3. Market innovation efficiency versus systemic risk costs. Post-Terra collapse, Singapore MAS's reforms quantify the balance. The 300% collateral requirement increases stablecoin issuance cost by 170%, but reduces systemic risk compensation payouts by 94%, raising total social welfare by 23%. The optimal regulatory intensity lies at the intersection where marginal risk costs equal marginal innovation benefits. Students, today we systematically study the 4 core dimensions of digital currencies regulation through specific cases: legal attribution mechanisms, technologically penetrating supervision, international coordination mechanism, and dynamic balance construction. Through this lesson, we have learned that the core of digital currencies regulation lies in building a resilient legal, technological, international coordination trinity framework. Future regulation must, within the dynamic tension between technological radicalism and financial conservatism, transform institutional rules into machine-executable genetic code, thereby fortifying the protective barrier for systemic stability in the digital economy era. Finally, please complete the following exercises. This concludes today's lesson. Goodbye.